Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for the Financial Services Virtual Investor Conference. We'll start today with a keynote presentation, The Changing Composition of Bank M&A from Commerce Street Capital. Please note you can submit questions in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Eric Corrigan, Senior Managing Director, and Justin Hughes, Managing Director of Commerce Street Capital. Welcome, Eric and Justin.
Hey, thank you, Matt, and thank you everyone for joining us today. We're honored to be part of this virtual investor conference, and today we want to talk about the changing composition of bank M&A. I'm Eric Corrigan, a Senior Managing Director and Head of the Financial Institutions Group at Commerce Street Capital. I've been doing this for over 30 years, advising community banks on raising capital, selling their business, buying other businesses, and general matters related to strategy. Joining me today is Justin Hughes.
Hi, my name is Justin Hughes. I work with Eric closely in the FIG group, and I've spent most of my career as an institutional investor for various funds. Most recently, a bank-focused fund investing in community banks throughout the U.S. Today, we're going to talk about the change in bank composition, but first we wanted to go over some of the relative performance of banks compared to the market. Obviously, most of us are very aware of this slide. You've seen the S&P outperform both the bank indices, and the S&P's up about 16% year to date. Bank and other regional bank indices are down about 20 to 22%. But as we've seen, micro-cap banks have largely outperformed the broader bank indices. Some of that we'll talk about a little bit later. The next slide, obviously we're looking at valuations. As you can see, COVID hit, the market valuations came down, people sold out of banks. You've seen broader banks outperform from a multiple standpoint. The smaller banks, there's always typically a premium. Investors rotate out of banks and other cyclical industries. Small caps get rotated out of into large caps. And once you see a bottom, a lot of investors recently have favored growth over cyclicals. But we think new capital might be coming into micro cap banks. And really there's two trades that a lot of people look to within banks, and we don't do research coverage or anything like that, but a lot of our conversations have indicated, a lot of investors have positioned themselves for some of the multiple coming back into banks as ETFs and mutual funds participate back in the sector. And then you have a broader kind of bank consolidation theme that a lot of investors are looking at.
One of the things that's been weighing on banks is the unprecedented movements in the Fed's federal funds rate target. If you go back to 2001, when monetary policy was extremely accommodative and interest rates were very low, that combined with the infusion of liquidity into the system from some of the steps that were taken in light of the pandemic, banks were actually faced with the problem of having too much cash. They were then encouraged to deploy that cash in some meaningful way by either investors or regulators or shareholders to say, we can't just sit on cash earning basically zero. We have to find some place to put it. As the Fed started to raise rates, and you can see on the chart, it's not just the magnitude of the raise, it's the velocity of the raise. The amount that was done over a very short period of time caught banks off guard. And you can see that depositors, seeing that they could get better rates outside of banks, started moving their money into money market accounts. So the growth of money markets just this year has been $825 billion, and that is mostly coming out of the banking system. On the next slide, you can kind of see the effect of this. So we've highlighted when we saw the failures of Silicon Valley and Signature. And you can see in the period right after that, a very large drawdown on the gray bar of deposits out of smaller banks and into large banks. This was the phenomena where we were seeing deposits move into banks that were deemed as too big to fail, like a JP Morgan, a Bank of America, et cetera. And so this put enormous pressure on smaller banks in order to redefine what their funding mix was going to be and on the cost of those funds. And we've been tracking this going forward. You can see in the last couple of periods in August and in September, we've actually seen movement back into banks. And so this fluctuates quite a bit. And if you look historically, look at the figures in the early part of 2001, that is a meaningful movement of liquidity into the banks and then a meaningful subtraction of liquidity from the banks as we saw these failures. On the next slide, that has forced banks to find alternative sources of funding. There's been a lot written about the use of the Federal Home Loan Bank as a source of liquidity. That's really not what its intention was when it was chartered in the Depression. The idea was to have a secondary market so that banks could continue to make mortgages and encourage home lending, but it's become a secondary source of liquidity for banks. In addition, the discount window, something that banks are historically loath to use, it's viewed as a sign of weakness, but the Fed was encouraging banks to use it. And then they created the Bank Term Funding Program, wherein they could pledge securities at par value and borrow against them for 1 year at a preferred rate. And you can see the use of that facility is up to about $121 billion at the end of August. So this movement of deposits out of the system into money market funds forced banks to find alternative sources of funding.
The next slide we're looking at, obviously you can see historically as the Fed had their zero interest rate policy, banks were forced to lower their wholesale funding because interest rates were at zero, and to earn any kind of NIM to speak about, you had to lower your cost of capital and cost of deposits. And so you saw a lot of banks focused on non-interest bearing deposits. Well, obviously, rates bottomed in 2021. And at that time, a lot of banks had really taken down their broker deposits, wholesale funding, CDs. And so, unfortunately, at the time that rates were at their lowest, wholesale funding was at its lowest. And so what really surprised banks was, obviously the velocity of rate increases, both on the impact on their securities, but also on their deposits. As as you saw, the growth in money market funds took some competition, competitively took some market share from banks. Banks historically, there's been a lag between their deposit rate increases and the Fed's rate increases. And so with the competition, you really saw kind of a increase in outflows of the banking system, which is stabilized. But as you can see from the slide, CDs as a percentage of deposits have gone up. And it'll be real interesting to see once the bank term lending facility expires next year, how banks are going to be positioning their wholesale funding going into that. I think a lot of banks are hoping to see some sort of new tool or what kind of policy the Fed will come out in front of the expiration of that facility. And so I think a lot of banks are asking those questions now. You're still seeing a lot of banks out there raising CDs, some of them at 6%. And so it'll be real interesting to see. One thing we've also learned is, a lot of banks are asking themselves, we've got these core deposits, but they're also really learning what are core deposits. Deposits, as we saw in the first quarter, some people considered those core deposits, and then they obviously exited the bank very quickly. And so that question is being asked a lot inside boardrooms.
So this just gives you a sense of what's weighing on bank stocks, right? So if you look at our first slides and you see the underperformance of the sector, it's largely explained by these factors around interest rates and deposit flows. And all of that then has an effect on what we see in M&A activity. So Justin will talk about that now.
I think most people know this. Obviously, the number of transactions has declined this year to about 66 versus 169 last year. If you analyze this year, that's about 94 deals so far, which would be a decline of about 44%. That decline is similar to what you've seen in private equity transactions, commercial real estate transactions. Obviously the environment has, caused people to pause and see what their funding sources are, and you have this spread of buyers and sellers, like we saw in the bank valuation chart, but also in the commercial real estate chart that we'll show shortly. And so, deal premiums have also come down. If you look at the deal values, it's come down about in half, and the same with multiples. Those have come down. Price per tangible book declined about 18% year over year so far. And so, one thing that we really look at is, you have to think about currencies for both the buyer and the seller. And when banks don't have a large currency that they can go out and purchase other banks, they tend to look internally at it's kind of a corporate finance equation. They look at internal growth, they look at internal sources and compare IRRs. And so when you don't have as much of a currency in your stock, you're going to look at other sources of deploying your capital and your IRRs. If you look at the deal distribution by price, it pretty much sums up what we've been saying. Most of the deals have been below 1.5 times book. There have been a couple of deals that have had some premiums, which is obviously encouraging data point. But really one thing that we look at are the number of banks that are trading above 1.5 book. That's typically when they start to feel, it's just kind of a rule of thumb, when they start to feel like they have a currency to go out there and do acquisitions. And obviously they want to, historically, they want to pay a lower premium or the lower multiple than what they're trading at to have, healthy earn backs and make the math work. And so, that's why you've seen kind of the distribution switch to the left, because they have to pay a lower multiple since their stock is trading at a lower multiple. Obviously, you've seen some continuation of the trends by state. There's always, in two cases, the states with the most banks will probably see the most consolidation just from a number standpoint, but you also see a lot of the demographic and economic trends in the South and Texas and the Southeast. You've seen a lot more deal activity there like you have over the last couple of years. A lot of that's just as banks are looking to grow into good geographies that are maybe outperforming some of the others. And in the Midwest, obviously you have a lot of banks, a lot of credit unions. You have consolidation within those areas, and so that's driving a lot of the activity kind of throughout the U.S. What's really interesting this year, and is typical of other kind of down cycles and multiples and valuations for banks, is typically you have your larger bank acquiring a smaller bank. Larger bank trades at a premium to what the smaller bank is trading at. And when you have the math, really change on you as quickly as we did this year, you see the composition of M&A really change. And what that'll lead to is, more MOEs. You have mergers of equals, which is where the buyer and seller are maybe, at similar asset sizes, and they have a depressed valuation, but they're still looking for scale. They're still looking to get some more liquidity in their stock. Maybe one has a little bit more capital or better deposit base than the other, and the other one has maybe a higher growth profile, a different kind of lending team, and so they'll merge as equals. And you're seeing that obviously increase this year. There's been a number of deals just announced in the last couple of weeks. And then you also always have kind of investor groups out there looking to, let's say they're veteran management teams that are looking to work for a smaller bank and have raised some capital from some seed investors. And so, obviously they're looking at, here are some banks out there that maybe want to sell ahead of any kind of credit cycle or concerns, or they have estate situations, or just older management teams that are investors that are looking for their own liquidity. And so you've seen an uptick in investor group deals out there. And then Eric will talk more about the credit unions. Obviously, they've been very active. But, these kind of non-traditional bank to bank, larger bank, smaller bank transactions have increased year to date.
And just on that point about investor groups, given that valuations are depressed, investor groups can actually be competitive in this environment. In an environment where valuations are up, they have a very difficult time being competitive relative to strategics. So I liken it to how private equity firms can take advantage of depressed valuations relative to a strategic buyer, because they can be competitive because they don't bring cost saves to the equation, but they can take advantage of a lower valuation parameter. Justin alluded to it on our next slide. One of the biggest changes we've seen in my career has been the proliferation of credit unions buying banks. This is highly controversial, particularly the bank lobbying organizations like ABA and ICBA are all the time chirping at Congress to change the rules, saying that credit unions, because of their tax-free nature, have an advantage in these transactions. However, from a bank perspective, credit unions offer a good alternative to a bank partner, because credit unions are trying to expand their knowledge of commercial lending. They've historically been home lenders and auto lenders, and usually do not have expertise in commercial real estate or business lending. So if they can buy a small bank and pick up that expertise, it's very helpful for them diversifying their business. From the bank's perspective, credit unions have to pay cash. They cannot issue stock because they're mutually owned organizations. They tend to keep most, if not all, of the staff of the selling bank. And they tend to pay a very fair price. And in the early innings of this, they were actually paying pretty significant premiums to what a bank could pay. So what we've seen is a massive uptick in the number of deals per year. And you can see just this year, we've had 10 transactions. I'm personally aware of 4 or 5 other transactions that are in various stages. I would expect this to be a record-breaking year. The other thing that's happening is that it's happening with bigger banks. I will not be surprised to see a credit union buy a bank that's bigger than $1 billion by this time next year. It's important to understand on the next page, this is not going to happen in every state. If you can see, there has been a concentration of where this is happening, and there's a couple of reasons for this. In certain states, by statute, credit union acquisitions of banks are prohibited by law. In other states, a credit union has attempted to buy a bank, and the legislature has actually retroactively changed the law to prevent it, Colorado in particular. In Tennessee, the state regulator sued to stop a deal and lost. In Mississippi, the legislature changed the rules. So we're not going to see these in every state. Obviously, where there is a precedent, we would expect additional deals in those states. But this is a little bit of a one-off type phenomena, but one that investors and banks should be aware of, because they actually have done transactions with publicly listed or OTC listed companies. So it is another potential source of liquidity for those banks.
Yeah, one thing I wanted to add too is both in credit unions and banks, the magic number used to be we're going to grow to $1 billion and then look at other alternatives. What you've seen for both credit unions and banks is that 1 billion kind of magic number has changed over time as the cost of doing business has gone up, as the big banks have gotten even bigger. It's put a lot of pressure on banks to grow more than $1 billion. In addition to credit unions, and the banks that a lot of small banks thought were going to be a potential acquirer either got bigger or acquired. And so that's putting kind of some pressure. It's kind of the underbelly of some of this pressure for banks and credit unions to grow even more than $1 billion to try to give themselves more strategic options.
I see we already have some questions, which is terrific. We have one small section to cover, and then we'll get to your questions. So let's transition to, and this will answer one of the questions, which is, what is our view of what's going to happen with commercial real estate and credit?
So obviously, we're all very aware, and we won't talk too much about it. The Fed continued to have this higher for longer perspective, and maybe there's been some shifts, obviously, in the expectations for rate cuts. And so the higher for longers here, they didn't rule out another increase this year. What you've seen in the CRE financing markets is SOFR has increased even more than some of the typical treasury rates and things like that. So the spread has gone up between SOFR, and a lot of that is embedded in just higher risk premiums for real estate, because we've seen a lot of transactions been held up in the commercial real estate world because you have this massive expectation from buyers and sellers and mismatch. Cap rates have been a little bit slower, and they're traditionally slower to adjust to the markets. And so, for a long time, we've really been in this kind of twilight zone where it's frees up, expectations on both sides. And so transactions have come down. So what does it mean for banks? Banks obviously have a lot of exposure to commercial real estate. The life insurance industry has been expanding their exposure to commercial real estate. Obviously, there's some differences there because you have difference in duration. And so life insurance companies typically can, extend for longer terms and maybe a lower rate because they're matching the duration of their business. And so, banks and savings and loans account for about half of the CRE debt outstanding, and the 25 largest banks are about 30%. What's really interesting too is that, okay, well, where's the exposure within the banking system? And as you can see from the bottom slide, the smallest banks, those under 100 million, they don't have a whole lot of CRE activity in their markets, so their exposure to it really hasn't increased that much. And on the flip side, the largest banks, the GISBs, they're primarily involved in the CMBS market, and they've kind of expanded their balance sheets into real estate, but more in agency securities, single family mortgages. And so on the commercial side, you've seen this market shift to the regional banks and the larger commercial banks, as you can see from the chart there. And so that has really, gone to kind of bank concentration ratios. So if you're looking, if you go back to the great financial crisis, there was interagency guidance looking at banks' concentration to CRE in relation to their capital levels. And so they came out and they started looking at construction land development loans and the relative exposure to their capital, but also just your total CRE exposure. And obviously banks have, in this part of the cycle, they increased their exposures to commercial real estate, some of that to the market share shift that I mentioned. But you also have seen kind of this last quarter, a little bit of a flattening in the concentration ratios. I expect that to probably come down. Banks have increased their lending standards. You've seen kind of slowing of pipelines, slowing of loan growth to commercial real estate. A lot of their bigger banks are requiring deposits if you're a borrower, commercial real estate borrower. And so the terms and structure, and they're requiring more collateral, has really kind of frozen up the markets a little bit. And so those concentration ratios have started to kind of flatten, both on a construction and just a total CRE exposure.
So we are running out of time here, so we're just going to go and there's more slides that we want to go through, but we don't have the time. I'd rather answer questions. At the very end of our presentation, here's our contact information. One of the questions we had was, would these slides be available? I believe they are. If not, if you cannot get them from the platform, please email us. We'd be happy to send them to you. The first question is really, are regulators in favor of bank industry consolidation? That investors seem to get a mixed message on that. It depends on the size. I actually happened to run into one of the preeminent banking regulatory lawyers in the country and actually in the world the other day, and asked him what he thought. And effectively what he told me was, if the bank is under 10 billion in assets, it's not a problem whatsoever, assuming that the buyer is in good standing with the regulators. For banks that are larger than that, and particularly call it 50 billion, 100 billion type banks, there is both political blowback and regulator caution about having those transactions done. So I would say, yes, there's going to be bank consolidation, but I would think that most of it's going to be concentrated in banks that are less than $10 billion in assets. The next question is, what are your thoughts on bank deposits as we head into Q3 earnings? I'll give my point of view and then I'll ask Justin to weigh in. Anecdotally, and the data that we showed with regard to flows would tell us that actually deposits have started to come back into the system. A lot of that doesn't mean that these are low-cost deposits. It's just that banks have been so aggressive in their marketing campaigns for CDs and money market funds. If any of you are in Texas, for instance, if you drive around, there are actually billboards that you can see with banks advertising very attractive short-term CD rates. And so people are taking advantage of that to try to lock in a pretty good yield. But I have the expectation that deposits will not be down. They might actually be up. So Justin, do you agree?
The conversation I have are the same, continuing to try to lock up deposits while you can for now. Maybe you have to pay, protect your core customers. You don't want them going to another bank for a higher rate. And so, obviously banks are very careful. They don't want to hurt their NIM too much, but they want to take care of their customer and service their customers. So, you still have a little bit of a lagged effect there. But as far as the absolute dollar deposits, they seem to be, have quieted down much more than earlier in the year.
What's your outlook for banks in the $1 billion to $5 billion space? I would say this is where you kind of see the biggest squeeze. And when I say squeeze, I mean almost having the same pressure on you from a regulatory perspective as a larger bank, the same pressure on you from a technology investment requirement, and the same pressure on you from funding costs and competition. So effectively what we say is $1 billion bank needs to become a $2 billion bank. Take whatever size you are and double it. And that's what you need to be more efficient. So that's why we're going to see more mergers of equals or mergers of similarly sized banks, because the way to overcome those hurdles is to split all of those costs among a bigger asset base. And that's the most efficient way to do it in the current market environment. Hey, we're running out of time here. Justin and I really appreciate everybody logging on today. We appreciate all of your questions. They were terrific questions. Thank you to OTC Markets for having us today. Again, our contact information is here. If you'd like a copy of the slides, if you'd like to get in touch with us with additional questions, please feel free to reach out. Enjoy the balance of your weekend.